If someone asks you right now to explain what futures trading actually is, could you do it? Not kinda, not it's kinda like stock but different. No, I'm talking about a clear, real explanation. A lot of people, even those already trading futures, cannot. They open an account, find a few videos, look for a strategy and start placing bets. But they never ask themselves the most basic questions. What am I actually trading? Why does the market exist in the first place? That gap causes problems later. Problems that look like strategy is the issue but are really the gap in understanding. In this video, I'm going to give you a precise, plain English answer to that question. What is futures trading? And hopefully by the end, you will see the market with a level of clarity that most traders never reach, even after years in it. I'm Bobby Wang, founder and lead instructor at Lumeric Trading. We build structured, no-hype futures education for independent traders. This video is part of our Futures Fundamental series and it maps directly to chapter 1 of the curriculum. If you're new here, the first 2 videos on the channel will give you a clear picture of what we're building and how to approach trading the right way. You will also find links to our free course, the Comprehensive Futures Trading Program, and our official course book in the description below. Alright, let's answer the question now. What is futures trading? At its core, a futures contract is a legally binding agreement between two parties to buy or sell a specific asset at a set price on a set date in the future, hence the name futures. That is the definition, but the definition alone does not build real understanding. Let me illustrate that for you. Imagine you're a wheat farmer. You plant in the spring and harvest in the fall. Between those 2 points, you have no control over the price. If wheat prices drop by the time you're ready to sell, your entire season could possibly turn into a loss. So you decided to make an agreement today. You find a buyer, a flour mill that needs wheat in 6 months, and you lock in a price now, $50 a kilo for example, delivered in October. That agreement is a futures contract, but this agreement benefits the both of you. The farmer knows what they will earn, the mill knows what it will pay. That is the original purpose of the futures market, reducing uncertainty. Airlines use it to lock in fuel costs, manufacturers use it to stabilize raw material prices, agricultural businesses use it to protect against price swings at harvest. So how about trading? Well, speculation came later. For those businesses to lock in prices, someone has to take the other side of that trade. That is where traders come in. We're not hedging business risk, we're taking on price risk, aiming to profit from how the market moves. And in doing that, we provide the liquidity that makes the entire system work. This is not just an economic theory. By understanding this, it changes how you see the market. This is not playing 3-card poker in the casino. You're operating inside a system built to transfer risk from one participant to another. And once you understand that, you will find price movements making a lot more sense. When most people say futures trading today, they're usually talking about financial futures and often equity index futures such as S&P 500 futures, or often called ES, and the NASDAQ 100 futures known as NQ. These contracts are not about delivering physical goods, they are cash-settled contracts based on the value of a stock index. But futures market go far beyond that. You have commodity futures such as crude oil, gold, natural gas, agricultural products. You have currency futures tied to major exchange rates. You have interest rate futures based on government bonds, and more recently, cryptocurrency futures. How can we not talk about that? Each of these markets operates under the same structure but with different specifications. Every contract defines 4 key elements: the contract size, the tick size, the expiration date, and the margin requirement. The contract size tells you how much exposure one contract represents. The tick size defines the smallest price movement and how much that movement is worth in dollars. The expiration date sets the lifespan of the contract, and the margin requirement is the capital needed to control that position. For most retail traders, the focus tends to be on equity index futures. That means understanding the ES and NQ for full-size contracts, or the MES or MNQ for micro contracts, which are 1/10 the size. These details are not technical trivia. They directly impact how you manage risk. If you misunderstand something as simple as tick value, your position sizing will will be off, and that error compounds every time you trade. I break all of this down step by step in Chapter 1, Section 1 of Day Trading Futures, a practitioner's guide for independent traders, so you can understand exactly what you are dealing with before you submit a order. If you're coming from stocks, we're deciding between the two. These are the structural differences that actually matter. First, leverage. With stocks, you either pay the full price or use margin within regulated limit. With futures, you control a large position with a relatively small deposit. One ES contract can represent hundreds of thousands of dollars in exposure, while the margin requirement might be as little as $500 for intraday position. That leverage works both ways. It can accelerate gains, but it can also accelerate losses. In futures, market risk and leverage risk are always tied together. This is not something to avoid, but it is something you need to manage through proper position sizing from the get-go. Second, directional freedom. In stocks, going short is a different process. You need to borrow shares, and there can be restrictions. Sometimes stocks are just hard to borrow, and brokers may charge you extra for that. In futures, going long and going short are identical. You can sell first, then buy back later, no extra steps. No borrowing, no added rules. In a market that moves both up and down, that flexibility is a real advantage. Third, trading hours. US equity futures trade 23 hours a day, 5 days a week. Stocks trade about 6.5 hours. If you're outside the US, this matters. Futures give you flexibility to trade during hours that actually fit your schedule while still accessing active markets. Fourth, tax treatment. In the US, future receives more favorable tax treatment than short-term stock trades. For the rest of the world, the specifics depends on where you are. So this is something to verify for your own situation. But the distinction is important. Additionally, trading futures does not trigger wash sale rules like stocks. This is a serious advantage for day traders. There are structural differences between trading futures and stocks, and understanding them help you decide not just how to trade, but what to trade. Quick pause. If you find this video helpful to you, go ahead and like the video and subscribe. It helps our video reach other traders who are serious about learning the right way just like you. And drop the word trading in the comments below. We will send you our free guide, 7 Reasons Why Independent Traders Fail. It is built on the same framework we teach here, and it's a must-read for beginners. Let me close this section by being very direct. Please, futures trading is not a shortcut to financial freedom. It is not passive income, and it is not something you can approach casually with signals and borrow capital. It is a professional skill, and like any skill, it rewards people who take the time to understand the market, manage risk with discipline, and execute decisions without being controlled by emotion. The reality is this: most people who enter trading lose money. The data is clear on that. However, it is not a reason to avoid trading. It is a reason to approach it the right way. Futures trading carry real risk. Trading in general is not suitable for everyone, and anyone who presents it otherwise is not being honest. The goal of this channel and Lumeric as a whole is not to promise outcomes. It is to close the knowledge gap that caused most traders to fail and give serious individuals a framework that actually improves their odds over time. Here's what to take from this video. First, a futures contract is a binding agreement to buy or sell an asset at a set price on the future date. It exists for hedging. As traders, we participate as speculators, providing liquidity that keeps the market fluid and functional. Second, futures markets span multiple asset classes: equity indices, commodities, currencies, and interest rates. For most independent traders, equity index futures like ES and NQ are the starting point. Third, futures offer clear structural advantages over stocks, especially for day traders. Access to leverage, equal ease of going long and short, and near continuous trading hours. In many cases, there are tax advantages as well. But those advantages come with real risk, especially around leverage and execution, something we will continue to repeat a lot in the future. Fourth, understanding what you are trading is not optional. It is the foundation. If you cannot clearly explain what futures trading is, that gap will eventually show up in your result. Next, in this series, we break down how a futures trade actually gets executed from your order through the broker into the market, and what is happening behind the scenes that most traders never see. If this gave you a clear sense of what this channel is about, go ahead and like the video and subscribe. We post structured futures education every week, and each video builds on the last. If you're going to follow this, follow in sequence. Comment trading below and we'll send you the 7 reasons why independent traders fail guide. It is free and is tied directly back to the 4 pillars we covered today. If you are ready to go beyond YouTube, the Lumeric Trading program walks through the full framework in depth. Market dynamics, trade analysis, risk management, and trading psychology. All structured and taught step by step. You will find the link in the description. And for those who want more of a personal touch and direct guidance, I offer limited one-to-one coaching sessions where we take a focused, in-depth look at your trading, your process, your decision, and where things need to improve. You can book that directly through the website or in the link below. Our official course book, Day Trading Futures, A Practitioner's Guide for Independent Traders, is also available on Amazon. It is the written version of everything we teach here. Even the preface alone will give you the right perspective before you go further. If you'd like to learn more about futures trading, click this video. You're one video closer to being a professional futures trader. Thanks for watching, and we'll see you in the next one.